The disposition effect is a behavioral bias observed in financial decision-making, where investors are more likely to sell assets that have increased in value, winners, and hold on to assets that have decreased in value, losers. This phenomenon goes against the conventional economic theory of rational decision-making, which suggests that investors should evaluate their investments based on their expected future returns rather than their past performance. Loss aversion is a fundamental principle in behavioral economics. Individuals tend to feel the pain of losses more acutely than the pleasure of gains. Investors are often reluctant to realize losses by selling underperforming assets, as doing so would require them to acknowledge their losses and face the associated emotional distress. The disposition effect can also be driven by regret aversion, whereby investors are motivated to avoid the regret of selling an asset that subsequently rebounds in value. Fear of regret can lead investors to hold on to losing positions in the hope of recouping their losses, even when it may be rational to sell. Mental accounting refers to the cognitive process, whereby individuals categorize and evaluate their financial resources based on subjective criteria. When evaluating investment decisions, investors may mentally segregate gains and losses into different accounts, leading them to treat gains and losses differently. This mental accounting can contribute to the disposition effect by influencing investors' decisions to sell winners and hold on to losers. Overconfidence bias is another psychological factor that can contribute to the disposition effect. Investors may overestimate their ability to predict future price movements or time the market, leading them to believe that underperforming assets will eventually recover in value. This overconfidence can result in suboptimal decision-making, as investors fail to objectively assess the fundamentals of their investments. Investors often use reference points, such as purchase price or recent highs and lows, to evaluate the performance of their investments. When the market price of an asset falls below its purchase price, investors may perceive it as a loss and become more reluctant to sell, regardless of its intrinsic value or future prospects. This anchoring effect can contribute to the disposition effect by influencing investors' perceptions of gains and losses. The disposition effect contributes to market inefficiency by distorting asset prices and preventing them from reflecting their true fundamental values. Assets may become overvalued or undervalued relative to their intrinsic worth as a result of investors' biased buying and selling behavior. The disposition effect can lead to underperformance for investors who succumb to the bias and engage in suboptimal trading strategies. By selling winners too early and holding on to losers for too long, investors may miss out on potential gains and incur unnecessary losses.